Imagine a world where simply adding .com to your company's name sends investors into a frenzy. In the late 1990s, it happened. A speculative fever gripped Wall Street, driving the Nasdaq index from under 1,000 points in 1995 to more than 5,000 by March 2000. Venture capital flooded into internet startups that had no products and no profits. For a moment, it seemed like the internet would make everyone rich, until the bubble burst and trillions of dollars vanished. The dot-com bubble, also called the Internet bubble, was fueled by a perfect storm: the commercialization of the Internet, unprecedented venture capital, and a stampede of investors chasing the next big thing. Startups claimed they would transform commerce, communication, even society itself. Many entrepreneurs believed traditional business metrics no longer applied. What mattered was eyeballs and market share. Yet few of these companies had clear revenue streams. Investors poured money into firms without verifying their fundamentals. Among the early winners were household names like Yahoo, AOL, Amazon, and Qualcomm, whose stocks skyrocketed. Yahoo's share price surged over 600% between 1996 and 2000, giving it a market cap of around $125 billion. Qualcomm's stock rose more than 2,600% in 1999. Meanwhile, telecom supplier Cisco briefly became the world's most valuable company after its stock jumped more than 1,000%. Such success stories convinced investors that anyone could win big. In 1999 alone, nearly 40% of all venture capital went to internet companies, and more than 450 dot-com startups went public, raising billions. Many spent as much as 90% of their budget on marketing, believing name recognition was everything. A few brands symbolized the exuberance. Pets.com, famous for its sock puppet mascot, raised $82.5 million in its February 2000 IPO. Despite backing from Amazon, the online pet store collapsed within 9 months. Its business model couldn't overcome high shipping costs for low-margin goods. Another high flyer was Webvan, an online grocery delivery startup. Armed with nearly $1 billion in venture capital, Webvan built automated warehouses and launched in multiple cities before proving the concept. Rapid expansion left it burning cash, and the company filed for bankruptcy in mid-2001. Even success stories like AOL and Yahoo contributed to the frenzy. AOL's stock price increased over 70,000% between 1996 and 2000, while Yahoo splurged on Super Bowl commercials and acquisitions. At its peak, AOL merged with Time Warner in a deal worth $165 billion, later described as one of the worst mergers in corporate history. Marketing excesses were everywhere. Dot-com companies paid millions for 30-second Super Bowl spots, hired celebrities, and printed glossy magazines. Investors rarely asked, "Who is the customer? How will this company make money?" The accepted wisdom was that first-mover advantage would eventually translate into profits. Amazon and eBay, however, took a different approach. Amazon focused on customer service and reinvested heavily in logistics, while eBay built community through its auction platform. Their share prices still surged. Amazon stock rose over 5,000% from its 1997 IPO to the 1999 peak. But they invested in infrastructure rather than marketing hype. By 2000, warning signs emerged. The Federal Reserve started raising interest rates in 1999 to curb inflation. Higher borrowing costs made bonds more attractive relative to riskier tech stocks. Meanwhile, hundreds of copycat startups saturated the market, offering similar services and diluting potential revenue. Critics pointed out that many dot-coms had never made a profit and were surviving on investor cash. Analysts at investment banks continued to issue buy ratings, partly because their firms earned lucrative fees underwriting IPOs. The conflict of interest kept valuations artificially high, fueling the bubble further. Companies like Pets.com and Webvan soon reported heavy losses. Webvan's plan to build a nationwide network proved unsustainable, while Pets.com discovered that dog food is expensive to ship and easy to buy locally. eToys.com, an online toy retailer, saw its stock price soar 280% on its first trading day, but filed for bankruptcy in 2001. Market sentiment shifted. Investors realized that valuations were disconnected from reality, and the fear of missing out flipped to fear of losing everything. On the 10th of March 2000, the Nasdaq Composite peaked at 5,048 points. In the weeks that followed, major tech stocks began to slide. Dell and Cisco executives sold shares, triggering panic. Investors rushed for the exits. Within weeks, the market lost 10%. By October 2002, the index had fallen to 1,139, a staggering 76.8% decline. Many startups vanished entirely. Those with hundreds of millions in market cap became worthless in months. Pets.com's shares, once issued at $11, traded at 22 cents the day it declared bankruptcy. Trillions of dollars of investor wealth evaporated. The collapse triggered layoffs across Silicon Valley and caused ripples in global markets. It also undermined confidence in investment banks and prompted regulatory reforms to separate research and underwriting to prevent conflicts of interest. The dot-com crash ushered in a period of introspection. Many companies failed, but a select few survived and flourished. Amazon and eBay emerged as e-commerce powerhouses by focusing on customer experience and sustainable growth. Cisco and Qualcomm weathered the downturn thanks to strong underlying businesses. The crash taught investors to value profitability and solid business models over hype. Regulators responded by strengthening disclosure requirements and tightening auditor independence rules. Analysts became more cautious, and the term irrational exuberance, famously used by Fed Chairman Alan Greenspan, entered the public lexicon. The Nasdaq took 15 years to reclaim its previous high, illustrating the depth of the crisis. But in the aftermath, the groundwork was laid for Web 2.0, social media, smartphones, and cloud computing. For Silicon Valley, the dot-com bubble was both a cautionary tale and a rite of passage. The hubris of the late 1990s gave way to a more disciplined approach to innovation. Why revisit this story? Because history echoes. Today we see booms in artificial intelligence, blockchain, clean tech, and more. Many new companies promise to change the world, and valuations soar before profits appear. The dot-com bubble reminds us that technology alone does not guarantee success. Sustainable revenue models and disciplined spending are essential. Overvaluation, easy money, and herd mentality still threaten to create bubbles. Rising interest rates can puncture optimism, and market saturation can quickly erode profits. The lesson is clear. Innovation must be matched with execution. Investors should look for fundamentals, not just flashy names. For entrepreneurs, the dot-com era shows that good timing, customer focus, and prudent growth can turn a crisis into an opportunity. As you watch the next wave of tech hype, remember the companies that rode the dot-com wave to success and those that crashed upon its rocks. The internet revolutionized our world, but its first boom taught us humility. The story of the dot-com bubble is a tale of dreams, greed, collapse, and renewal. By looking back, we can better navigate the waves ahead. Join us for more hidden histories and technology tales, because understanding the past prepares us for the future. The dot-com bubble was just one chapter in the story of how technology can change everything, and then break everything. If you found this breakdown helpful, consider subscribing so you don't miss the next hidden story behind the headlines. Leave a comment and tell us, which part of the dot-com bubble surprised you the most? Thanks for watching, and I'll see you in the next one.